good morning, you are in the world, or even good evening. So my name is Nick Spencer-Ski, and I'm Senior Executive Officer of APM Capital Limited here in Abu Dhabi. We are a ADGM, that's an Abu Dhabi Global Markets regulated company with an FSRA Cat 2 license. And once again, in conjunction with the CME, we are delighted to welcome back a guest speaker today, Tariq Dennison, who is going to be talking to us about S&P 500, Nasdaq, and Dow Jones, which is great timing 1 week in front of the US elections. So I won't go through, a lot of you have met Tariq already, so I won't do the full bio. Tariq can introduce himself more, but he is a wealth manager and investment advisor based in Switzerland. He holds a master's in financial engineering from the University of California at Berkeley. He has 2 books, Invest Outside the Box and 10 Ways to Invest, and is also a frequent guest on CNBC, Asia, Street Signs, and RTHK's The Close. So with that very short intro, let's get back to the subject matter, which is probably what we're all interested in today. And I'll hand over to Tariq, and once we've finished, there will be a session for anybody who has any questions. And I'm sure with this particular topic and the timing of it, there will be a few questions at the end that we will want to spend a bit of time with. So Tariq, thank you very much, and catch you in a minute.
Wonderful, Nick. Thank you so much for having me. I'm probably even more excited to present this topic than many of you are to hear about it. Of all the different topics around futures, it's probably one of the ones near and dear to my heart, US stock market indices, because it's one that I can totally nerd out on. But I will today try and keep it high level and relevant to any of the questions you may have about these major stock indices, the S&P 500, Nasdaq 100, Dow Jones 30, and not mentioned here, the Russell 2000. This is done in partnership with both APM Capital and the CME Group. Disclosure information you can see on this slide here. Now, overall, as mentioned, this is about US stock market index futures. And as I've been starting many of these with an AI-generated image, you'll notice this is what happens when I ask AI to generate a bull and a bear fighting on the floor of the Chicago Mercantile Exchange. You'll see NYSE is in the background, and they put horns on the bear as well as on the bull. So limits there on AI and whatever that means for the AI investment thesis. But that's basically what we're presenting here. US stock market indices, there's 4 major ones on which there are liquid futures contracts that you can trade on the CME. Here I'm going to explain to you what those indexes are, what those futures contracts are, and how you can put together a trading strategy, whether you're a bull or a bear. So the nice thing about futures, it's easy to make money whether the index goes up or whether the index goes down. Before I continue, a very important disclaimer from me and my firm. And I was kind enough to be introduced well enough already, so I probably don't need to say too much more about myself other than the fact that I'm independent of both APM Capital and CME Group. I am just a humble trader and a professional wealth manager. I run my own independent practices, licensed in the US, Hong Kong, and now Switzerland, where I manage investment accounts on behalf of my clients who are too busy to do it themselves. This includes accounts that are basically managed futures strategies. And the reasons that I might use futures instead of ETFs or direct stocks and bonds may have to do with tax, may have to do with risk management, may have to do with liquidity. But you can probably tell listening to me for any 30-second interval, I am an absolute finance nerd. I have been fascinated with currency markets since the age of 6, fascinated with interest rates since I was probably about 10. I didn't buy my first stock till I was 17, so I was a little bit of a late bloomer to the equity market. But I eat, drink, and breathe financial markets, and I'm quite happy to talk about them in any different angle. So these are the covers of my 2 books. The latest one, 10 Ways to Invest, actually just came out in print. I just got copies of it here last week. If you ever have a chance to meet me in person, of course, I'd be very happy to sign a copy for you. So what are we going to talk about today? As mentioned, we're actually going to be talking about 4 different major liquid stock market indices. Now, chances are Most of you aren't going to be interested in all 4 of these. You're probably going to pick a top 2 that you're interested in for, for most cases and compare those 2. The big one that we're probably all familiar with is the S&P 500, but of course, very close behind that is the Nasdaq 100, which gets a lot of attention due to its position in the Magnificent Seven. And then the 2 other ones, not to be forgotten, one is the Russell 2000, which, as the name indicates, is broader and more diversified, but is actually the small cap index, representing very different companies, as we will see. And then let's not also forget the Dow 30. Many of us who just turn on the TV and we'll listen to how's the US market doing, we'll hear about the index called the Dow, which is quite different than the S&P and the Nasdaq, and we'll talk a little bit about why later. In addition to explaining what these indices are, I'm going to give you a little bit of a picture on what the metrics of these different indices are, what the current outlook is, what your relative risk return parameters might be if you were to trade one versus the other. Then I'm going to talk about the instruments that we use to trade them. Namely, in this presentation, I'm only going to be talking about equity index futures. So I'm going to be talking about S&P futures, Nasdaq futures, Russell futures. I did mention here a bullet point on futures options, but I will have to leave that to a different presentation. So please do leave in the comments or in the feedback if you would like to have another presentation specifically on option strategies. In this presentation, I'm only going to be talking about future strategies. Following that, we will have Q&A, and I think I've already lost the bet on whether or not there will be any questions about the US election, but we'll go ahead and leave that to the end. Hopefully there will be questions about many of the topics about the indices other than what will happen next week. So what are these different benchmarks? So on this slide, I really tried to summarize what these are. So the S&P 500, as the name implies, is 500 companies, not 500 stocks. It's actually about 504 stocks. The reason is some of the largest stocks in the index, some of the largest companies in the index, like Google, for example, or Alphabet, actually have 2 share classes, Class A and Class C, and both of those are in the S&P 500 index. But the S&P 500 index is only going to contain 500 companies. So that's where you'll see it's 500 companies, but technically 504 stocks. These are the largest and most liquid companies, not just in the US, but in the world. And the S&P 500 index is over 50% of the whole world's market cap, not just of the US, but of the world's market cap. So again, it's a very, very important index. And for many investors, it is the market, the benchmark. You pretty much have the S&P 500 and the world excluding the S&P 500, which again means lots of smaller US companies, but also all non-US companies. Now, the Nasdaq 100 is the second index we'll talk about. It has gotten a lot of attention because it tends to have a much higher weighting in large technology companies, including the companies that are in the Magnificent Seven. Now, one thing I should be clear about, the Nasdaq 100 is not explicitly a technology index. It's only 59% information technology and IT-related communication sector companies. The way that it's defined is it is defined by companies that are listed on the Nasdaq trading venue and that are non-financials. So for example, you'll have companies like PepsiCo and Costco, which are not tech companies, but they're not financials. They trade on the Nasdaq market, which is why they are in the Nasdaq 100. And so that's one thing to keep in mind. The Nasdaq 100 still is I would say a fairly broad benchmark, but many may consider it's not as broadly diversified as the S&P 500 because it does not contain any financials and it does not contain any companies that trade on the New York Stock Exchange, which are many of the oldest and best known companies like Coca-Cola and IBM. So the next one is I'm going to mention here is the Russell 2000. The reason I'm going to mention the Russell 2000 before the Dow is the Russell 2000 provides the greatest diversification away from the large liquid components of the S&P 500 and the Nasdaq 100. Unlike the S&P 500, the S&P 500 is determined by committee and the Nasdaq 100 is determined by the exchange. The Russell 2000 is determined by a simple rule. Basically, the 3,000 largest stocks in the US by market value are sorted from largest to smallest. And the 1,000 largest companies are the Russell 1000. The next 2,000, so numbers 1,001 to 3,000 are the Russell 2000. So that's it. It's defined by a simple rule. There's no committee. There's no other parameter or profitability filter. It is quite simply a broad rules-based index of smaller US companies. Finally, you have the Dow 30. Now, as the name implies, it only has 30 stocks in it. It is the oldest of any of these benchmarks. It is also the simplest. By having only 30 stocks, it also is simpler in that it is what is called price weighted. So rather than being market cap weighted, you can perfectly replicate the Dow 30 simply by buying one share of each of the 30 stocks in the Dow 30. You cannot replicate any of the other benchmarks quite so easily as you can the Dow. So the reason I like the Dow, again, is it's very simple and easy to follow. You can probably know all of the names of the Dow 30. You can understand what they do. Whereas I do not know any professional manager who can name all the companies in the S&P 500. So to keep in mind that each one of these indices have a bit of a different flavor, give you a bit of a different exposure, and that's why it's worth knowing all of them. Now, if we were to zoom out, if we were to look at how these four indices have performed century to date, and now, pretty soon we're going to be going on 24, 25 years of this. We're almost a quarter of the way through the century. I started this on January 1st, 2000, and wanted to look at what the price return, this is price return, not total return, of these four indices have been since the year 2000. Now, until now, if we look until right now, the Nasdaq 100 seems like the clear winner on a price return basis, up about 450%. But if you step back a little bit, you'll notice that outperformance only really started in the past year. And the reason is that from 2000 to 2002, the Nasdaq 100 was by far the worst performing index. It was the one that had all those big tech companies like Cisco and Pets.com and Broadcom and Ariba, all of these very overvalued .com companies that came down. The index, I think, was down almost 80% from peak to trough. Whereas the other indices, which weren't as heavily concentrated in those big tech companies, fell, but they didn't fall quite as much. And you'll notice, especially the Russell 2000, which was really your kind of everyday Main Street companies, was the big outperformer really right up until COVID. Now, COVID, you'll see that those small companies fell a lot more than the large companies, which relied much more on technology and global supply chains. And then it was really from COVID that you saw the Nasdaq really soar and take off, the Russell kind of faltering a little bit. And, right now, if we look for the past 24 years since the year 2000, the Nasdaq 100 is up 450%, Russell's around 350%, S&P is up around 300%, and the Dow is up a little bit less than that, up around 273%. So if you follow year by year this chart, I think it tells quite a few stories in terms of which indices run ahead and which indices fall behind year by year in different sorts of market cycles. So that's the reason that I don't consider all four market indices to be the same, and why knowing about all four of them and how you might trade one versus the other can be very worth knowing and doing as a trading strategy. Now, I'm going to zoom in from century to date to year to date. And this would have been a chart where, even though it's much more recent, might have been a little bit harder for you to guess. So really what we see on the top is we see kind of neck and neck, the S&P 500 and the Nasdaq 100 going back and forth, and sometimes the Nasdaq coming ahead, the S&P coming ahead. And really most of this has to do with the Magnificent Seven. The S&P 500 and the Nasdaq both are dominated by the Magnificent Seven, but the Nasdaq has a higher weight in the Magnificent Seven. So when the Magnificent Seven is outperforming the rest of the market, the Nasdaq will pull ahead. When the Magnificent Seven is underperforming, the Nasdaq 100 is going to fall behind a little bit. That said, the difference between the two is about 1.5 percentage points year to date, so not a huge difference. The bigger difference is between the S&P and the Nasdaq and the other two indexes. So the Dow Jones Industrial Average has, I think, two of the Magnificent Seven companies in it, but not even top weights. And so when the Magnificent Seven outperforms, the S&P and the Nasdaq will significantly outperform the Dow, and vice versa as well. When the Nasdaq falls, the Dow would not fall quite as much. And the Russell similarly. I think what should be just as surprising is how much closer the Dow and the Russell are than the Dow or the Russell are to the S&P 500. So this is what sort of difference, what sort of spread you might expect over the course of 1 year. And hopefully some of you are already having those gears turning in terms of what strategy you might put on in terms of, let's say, S&P versus Russell or Nasdaq versus Dow as a possible pair trading strategy. We'll go into that a little bit more later. Now, breaking down the Magnificent Seven, now I think this is only about 5 of the Magnificent Seven here. I did want to highlight that 1/4 of the 22% rise in the S&P 500 year to date is attributable to one stock, and that stock is NVIDIA right there at the top. So as of the time I took this screenshot a few days ago, NVIDIA is 7.14% of the S&P 500. That stock is up 190% year to date. And so 7% times 190% is 584 basis points. That is 1/4 of the return of the index attributable to one stock. And then you can see the next two, Apple and Meta, were the next two biggest contributors to the S&P 500's return this year. I do this attribution using a tool called Koyfin. Of course, there are a lot of other tools you can use to break down how an index has performed better or worse, and you can do this side by side with the S&P versus the Nasdaq versus the Dow. That gives you pretty much a breakdown of what's made this index go up and down. Now, I want to look a little bit more closely at how much the Nasdaq versus the S&P. I mentioned earlier the Nasdaq tilts more to the Magnificent Seven than the S&P. And here we can actually put it in numbers. Now, this screenshot's a little bit older. I get it from a site called ETFRC. And actually what I'm doing here is I'm comparing the relative holdings and overweights of the ETFs tracking the two benchmarks, so SPY and QQQ. And here you'll see on each of those top components, each of those Magnificent Seven, the Nasdaq 100 has about 1.5 percentage points more weight in each of those companies. So 1.5% more in Microsoft, 1.5% more in NVIDIA, about 1.5% more in Apple and Amazon. So that's really where that extra weight comes from, is right there in those components. So with a tool like this, you can see where is the Nasdaq overweight and where is the Nasdaq underweight. If I were to look at which are the main companies that the S&P is overweight relative to the Nasdaq, these are typically going to be in large NYSE, New York Stock Exchange listed companies that are not in the Nasdaq 100 at all. Because remember, the Nasdaq 100 only includes companies listed on the Nasdaq. And you can see on the left what these companies are. First and foremost is Warren Buffett's Berkshire Hathaway, but it also includes other companies like Eli Lilly, JP Morgan Chase, ExxonMobil, Visa, MasterCard. So these are not exactly old economy companies. These are, a pretty good list of blue chips. It's just that they're blue chips listed on the New York Stock Exchange. By contrast, all of the underweights, the companies that have less representation in the S&P than in the Nasdaq, are on the right. They're all companies listed on the Nasdaq 100, and 7 of them are Magnificent Seven components. So there's the comparison of the S&P and the Nasdaq side by side. If we were to break it down by sector, now it should come as no surprise that given that the Nasdaq by definition excludes financials, that whatever the weight of financials is in the S&P 500, the S&P 500 is going to be overweight financials by that amount. And much of that overweight in financials is offset pretty much point for point by an overweight in technology on the NASDAQ 100 side. Now, the other overweight in the S&P 500 relative to the NASDAQ is in healthcare, and that is offset by the communication services companies on the NASDAQ. Those are companies like Google and Meta, for example. So this gives you a bit of an idea of the relative sector tilts of the two. And when you look at them, they are significant. You basically have 2 major sectors with an over 5 percentage point deviation in sector weightings, and one with a double-digit deviation in sector weighting. So you can almost look at these 2 sectors, and if you were to play, let's say, financials versus technology, or you were to play, payment processors versus, playing social media companies, that would be one trade that you could do simply using these 2 indices. So that was S&P Nasdaq. Now let's look at the Russell 2000. one tricky thing about the S&P 500 I should get out of the way, the S&P 500 is not the 500 largest companies in the US. It is 500 companies chosen by the S&P committee. And you may remember a few years ago, the S&P committee wanted to wait a few quarters before they even let Tesla in. So even though Tesla was a large company, because Tesla met their profitability criteria and others, but the S&P indices are chosen by committee. The Russell indices, by contrast, are done by a simple rule. And this picture here shows you how that rule works. So in 2023, you had the Russell 1000 companies. So the 1,000 largest companies in the US, where the largest company at the time was Apple with a $2.7 trillion market cap. And the smallest company was around 6 billion. The cutoff was at 4.2 billion. So any company that had a market cap above 4.2 billion was in the Russell 1000. Any company with a market cap below 4.2 billion was in the Russell 2000. Now, remember, the Russell 2000 is just the next 2,000 companies. There is also an index of even smaller companies called the Russell Microcap Index. Now, the Russell Microcap Index overlaps with the Russell 2000, but since we're not looking at liquid futures on that, there is an ETF. Since we're not looking at liquid futures on that, we're just going to focus on that Russell 2000, which you'll notice the total sum of the Russell 2000 companies is significantly smaller than of the Russell 1000. In fact, the Russell 2000, I think, if you add them all up, may even be smaller than that of the Magnificent Seven, if you were to just add those up together. So that was in 2023. What then happens in 2024 when it does the next rebalancing? Basically, Russell does this periodic review where it does the resort of all the companies, and then that little those striped bars that you see there. So in the 2024, you'll notice that the 4.6 billion line, the striped bars there under the Russell 1000, those were the companies that fell below the 4.6 billion mark. Those are going to get kicked out of the Russell 1000 and pushed to the Russell 2000. And then on the right side, you see those that are in that striped bar above the Russell 2000, above the 4.6 billion mark. Those are the ones that are going to get upgraded from the Russell 2000 into the Russell 1000. So there is a pretty active strategy of people who follow those top components of the Russell 2000, for inclusion of the Russell 1000, and they buy those and they try and short the small companies in the Russell 1000 that are likely to get kicked back into it. There is a strategy you can do there, although you're probably going to have to do that at the stock level because the indexed weight of the stocks in the Russell 2000 are so small, you're not really going to capture the returns by simply buying the Russell 2000 index. When you're trading the Russell 2000 index, you're really trading that entire block versus, say, the S&P 500 or the Nasdaq or the Dow as an entire block. In terms of valuation, now I love to look at these charts by Yardeni Research. If you want to visit their website, they've got lots and lots of charts that really break things down. But one challenge is they usually keep indices that are in the same family. So if I'm going to compare large caps and small caps, I'm going to be comparing S&P indices. So I'm not going to be comparing S&P 500 with Russell 2000. I'm going to be comparing S&P 500 with S&P 600, which is the S&P small cap index, which again is chosen by committee and has different conditions than the Russell 2000. But what this chart should show you is that large caps historically were slightly cheaper. So from about 2004 until 2018, large caps were cheaper than mid caps and small caps on a forward PE basis. Ever since COVID, and it's been especially exaggerated since about 2022, large caps are trading at a significant valuation premium to small caps and mid caps. So this is something that I'm really keeping my eye on because if you look at the very beginning of the chart, we've seen this spread before. Now again, not everyone's going to agree with me. There are reasons why you might say large caps may sustain a premium forever. But last time we saw large caps trading at 6 PE points above small and mid caps, we saw that spread converging within the next 2 years. I personally am of the view that the odds are in the favor of that happening again. Of course, we could argue and make a thesis either way, but here are the actual valuation ratios as charted by Yardeni Research. And you're going to think I sound like a broken record. Much of that valuation spread is due to the Magnificent Seven. Now, This chart is maybe not so clear in terms of the PE ratio, because what it does is it breaks down the three components. The green line at the bottom is the Magnificent Seven's share of the S&P 500's forward revenues. So right now, the Magnificent Seven generates 11% of the revenues of the S&P 500, and that's up from less than 4% in 2013. Now, that of course is all well and good. In terms of earnings, their earnings percentage has grown even more significantly, especially in 2023 and 2024. So you'll notice back in 2013, the Magnificent Seven were 8% of the S&P 500 earnings. Now they are 21% of S&P 500 earnings. And that was up from about 14% at the beginning of 2023. So this is part of the story, part of the narrative of the Magnificent Seven is this is not like 2000, where these are unprofitable dot-com companies. The Magnificent Seven are extremely profitable. They have huge moats. They have enormous economies of scale. They're very hard to compete with. That's a lot of the thesis behind them. But that's also why their valuation spreads have gotten even wider. So if you were to look at these three lines, the green has risen a little bit, the red has risen more, and the blue has risen even more. What is the blue? The blue is the Magnificent Seven's share of S&P 500 market capitalization, of market value. So right now, the Mag 7 is 29% of the index, which is up from only 7% in 2013. So that is really where traditionally value-oriented investors like me are thinking, I don't know if bubble is necessarily the right word. They may be getting a little ahead over their skis. In order for the Magnificent Seven valuation to be justified, those profits and those rates of growth need to be sustained at a rate that many of us don't think is likely. Now, that said, if you think it is likely, you may want to go long Nasdaq versus short the other indices. If, on the other hand, like me, you think you're likely to see a correction, you may want to sell Nasdaq as a protection and use some of the other futures to gain your long equity exposure. Finally, I want to talk about what is actually a long personal favorite of the four indices of mine, and that is the Dow 30. In fact, I've once joked that I should be called a defensor dowensis, or the defender of the Dow, because whenever people criticize the Dow for being an out-of-date index, I point out the Dow has a long continuous history of being very simple to calculate and very simple to replicate. I have put here right in front of you the 30 components of the Dow Jones Industrial Average. If you simply buy one share of each of these 30 companies, you will replicate the Dow perfectly. You could not really do that with almost any other index in the world, let alone an index that's been around for over 100 years. Now, when we mentioned their performance earlier, I mentioned only two. It's actually three of the Magnificent Seven are components of the Dow: Microsoft, Apple, and Amazon. And I've highlighted them there, showing that they're not even the top three components. That's because the Dow is a price-weighted index. You'll notice that I've sorted the weights of the companies in this index by the price per share, which initially sounds like a really weird way of weighting a company. You could have a small cap with a large price per share and a large cap with a small price per, what sense does that make? But the whole idea is that it's very simple. Don't forget, the Dow was created by journalists. It was not created by investment academics, and it was created as a way of simply creating an average of stock prices to tell if markets generally have been going up or down. And part of the idea is with these averages, a typical portfolio of direct stocks, and again, this was in the days long before index funds or futures, would roughly track the Dow because it was an average of the price of 30 stocks. And some of the things that you'll notice here, unlike, let's say, the Nasdaq 100, all of the Dow components, except for two, pay dividends. They all tend to trade at slightly cheaper valuations. So in many ways, they are quite different than the very top-heavy, tech-heavy indices of the S&P 500 and the Nasdaq, which is why I like looking at them. Because again, you can go through these names. Chances are, 2 out of 3 of these names, you can explain what they do, not just to me, but probably to your children as well. So that's enough about the indices. Now let's talk about index futures. Let's talk about the instruments that you can use. And I'm going to start off by comparing an index ETF. How do whether you want to trade the S&P 500 with an ETF versus trading it with a futures contract. So what are the differences between the two? Well, with an ETF, if you want exposure to $30,000 of S&P 500, you need to put up $30,000. You either need to pay $30,000 for those ETF shares, or you need to borrow them on margin. You need to somehow come up with $30,000. And if you want to sell short, if you want to make money from the index going down, you're going to need to borrow the shares to sell short. You're going to need to pay a borrow cost. You're going to need to worry about those shares being called back. There are frictions having to do with selling short, different from going long. If you hold an ETF, let's say a US domiciled ETF, and you're not a US investor and you're in a non-treaty country, you may face withholding taxes on any dividends paid by that ETF. And you may be triggered by estate taxes if that ETF is held in a jurisdiction that charges estate taxes. So index ETFs make sense if you are a buy and hold investor who's long and you're not planning to go short, you're not planning to trade a lot, and the ETF is domiciled in a tax-friendly jurisdiction. So all of those conditions are met. I think the ETF is a better instrument for indexing in those cases. What are the advantages of index futures? The first and obvious advantage is leverage. In order to get $30,000 of exposure to the S&P 500, you don't need $30,000. You simply look up whatever the initial margin is. It could be $2,000. And then as long as you have that in your account and you click, you will suddenly have exposure to that. In fact, if you do intraday trading, intraday margin on the S&P 500 is much smaller than that. So the amount of capital required for either a long or short position is much less with futures than it is with ETFs. The other thing is if you want to go short, let's say you're not even taking a speculative position. Let's say you've got long positions in stocks and you want to sell futures as a hedge. Well, if you want to buy that protection, one click, you've got a short position in the index future. You don't have to borrow anything. You don't have to worry about stock loan. It's all priced in. And if the index goes down, you make money. If the index goes up, you lose money. It's really, really very simple. Also, because it's a futures contract, there are no dividends. And so there's no dividend taxes to withhold. They're effectively all priced in the futures price that you're buying. So you'll notice, for example, when interest rates are very low, futures contracts will trade at a lower price than the indexes now. Right now, they trade at a slightly higher price. That's because you're not putting all the money up. You're effectively paying the interest on the money that you're not putting up, the interest on the rest of the 30,000, and then whatever the dividends are, those get netted out, and those are all reflected in the price with no dividend withholding tax. Also, because these are just contracts for whatever the difference you're paying, there's no estate tax exposure to worry about as well. Now, if it's cash in a U.S. broker, so APM Capital is not a U.S. broker, you might have to worry about margin being exposed to estate tax there. But if you've got a futures account at APM Capital, you at least don't have to worry about there being a U.S. situs asset with U.S. estate tax exposure. Once again, this is not tax advice, just something to keep in mind. Since I almost said contract for differences, I want to briefly mention what's the difference between a contract for difference, or CFD, and an index future. A contract for difference is a lot like a futures contract, except that it is a perpetual contract. So let's say, for example, if you were to buy an S&P 500 CFD, index CFD, you can hold on to that as long as you want. You never need to worry about the December expiring and rolling into the March. But there's a carry cost that's added to your position pretty much every day as you go along. On the other hand, whenever you buy an index future, your total cost of ownership is reflected right there in the price that you pay when you trade on screen. But if you buy the December futures and it expires on December 13th, you're going to need to get out of it before December 13th and then roll into the March. And then before the March, you're going to need to get out and roll into the June. So there is a little bit more maintenance on index futures, and that's something to keep in mind. So I use futures for strategies that I regularly review and rebalance. CFDs might make a little bit more sense if you want like a leverage position that you're going to hold on to for a lot longer. One thing I've also observed is that the direct spreads that you see, so the spreads between the bid and the offer, tend to be quite a bit tighter on index futures than they are in index CFDs. So if you're worried about really getting the same prices that the large institutions get, futures are your instrument of choice. So now let's look at the US indices. Now the absolute levels here are a little bit out of date, but the numbers are still more or less right. With the S&P 500, so basically with every single one of these indices, there's two contract sizes I want to look at. So the first one you have the E-mini and the micro E-mini. So with S&P 500, the E-mini is $50 per point versus the micro E-mini, which is $5 per point. What does that mean? When the index is around 5,500, that means the E-mini S&P 500 is going to have a notional value of around $275,000 a contract versus the micro E-mini is going to have a notional value of around $27,000 per contract. And the maintenance margin, so this is how much you're going to need to have in your account to not be liquidated out of the position. On a micro E-mini S&P, $27,000 of equity exposure can be maintained with only $1,180 in your account. So that's what, about 20 times leverage, which again, I never recommend pushing the limits on. In general, if I'm going to buy one micro E-mini S&P 500, I'm only going to do that in an account where I've got at least 10, 15,000 in, because I really do not like pushing my limits there. And same thing, you can look down this table. E-mini Nasdaq is $20 per point versus micro E-mini is $2 per point. That's roughly a $40,000 contract. Micro E-mini Russell is $5 per point for 2,000 index. That's roughly $10,000 per contract. And micro E-mini Dow is 50 cents per point. So that's quite useful when you're looking at an index that's around 40,000. That's around a $20,000 contract, again, with a maintenance margin of less than $1,000. So I would recommend going to the CME website to double check all these numbers for any contract you're interested in trading, but that gives you an idea of what exposures we're talking about. Now let's look at a specific example. Any of you who are looking to trade futures, if you're new to futures, please print out this slide and the next slide and put it on your desk. Make sure you master these slides before you trade any futures contracts, because this will explain quite clearly how leverage in futures works. Let's say, for example, I want to take a long position in one micro E-mini S&P 500 contract, which is $5 per point. And as I mentioned, I'm going to have at least $10,000 in my margin account to do that. I do that, I click, I am long one S&P at 5,500. And then the next day, the price goes up to 5,700. So woohoo, I was right. I was long, the index went up. My position is one contract, $5 per point. Index was up 200 points. 200 points times $5 a point is $1,000 profit. And that gets settled into my account even though I don't sell. So remember, with futures, your profit and loss get settled on a daily basis based on where those futures contracts are marked on the exchange, the settlement price. So on day two, my margin balance, my account balance is $11,000, and I'm still long that one futures contract. So futures contract went up, 1,000 is swept in my account. I have $11,000. Next day, unfortunately, the index goes down. The index is down to 5,300. It's down 400 points from the previous settlement. Those 400 points times $5 a point means $2,000 gets swept out of my account. And now I have only $900 left in my margin account. So make sure for any long position you've got in a futures contract, you understand exactly how each of these steps work, because this is how money gets swept in and out of your account with every trade. This slide is basically the previous slide in exact mirror image. This is what happens if I go short. Let's say I've opened this futures account to hedge my stock position, or because I believe the index is going to go down next week because of the election, whatever. I sell one micro E-mini S&P, $5 a point. I've got 10,000 in my margin account. So now I have 10,000 in my margin account, and I'm short one contract. The price goes up to 5,700. I'm short. The price went up 200 points times $5 a point. I lose $1,000, get swept out of my account. So I now have $9,000 left in my account, and I'm still short that one contract. The next day, the index goes down to 5,300. That 400 point decline from 5,700 to 5,300 means $2,000 gets swept into my account. I now have $11,000 in my margin account. So hope that is all very, very clear. This shows the exact mirror image of a long position versus a short position and how those settle into your futures account. Some terms to know for any of you who may be new to futures. One of the first ones to know is basis. So basis is the difference between the cash index price and the index futures price. And if you watch these on TV at all, you may see, for example, okay, the S&P 500 closed yesterday at 59.50, and the futures are now trading at 59.40 or whatever. The difference between those two is simply called basis. And as mentioned, the main reason there's a difference between the futures price and the cash index price is because of interest rates and expected dividends between now and the futures expiry. By the time the futures expire, those two will converge because the final settlement of the futures contract will be based on whatever the index is on that day. But if you're a month out, there's going to be a difference between the two because of those two factors. The other thing I mentioned earlier was settlement price. So the settlement price is that official daily closing price that the exchange uses to decide how much profit or loss to sweep into or out of your account, as I showed in the last two slides. If you want to tell how liquid a contract is, you're generally going to want to look at the open interest. Open interest simply means the total number of outstanding contracts, and that can be all the longs or all the shorts, because by definition, they have to be equal. So if a brand new futures contract is launched and I buy one contract from you, then there's an open interest of one, that one contract that you and I have open. And then if I buy another one from someone else, then the open interest is two. So because I'm long two, other people are short two, and that's how it adds up. So open interest is the total amount outstanding, whereas volume is how much is traded on a given day. Initial margin is how much collateral, how much cash you need in your account to enter the trade, whereas maintenance margin is how much you need to have in there so that the trade doesn't get liquidated. You'll have to look up what the initial and maintenance margin is on each one, and you can do that in MetaTrader 5 on your APM account, but that's what that term means. And finally, the thing to remember is that stock index futures are all cash settled. So when you buy a futures contract, if you hold it to the very end, basically the exchange is going to look at what the index value is, and it's basically going to settle that profit or loss in your account in cash. There's not going to be any physical delivery of the S&P 500 stocks into your account. That's how cash settled index futures work. What about strategies? Now, earlier, I've actually started with the third and most complex strategy here, which is a relative value strategy. But the simplest one that you might do is you might just do a tactical strategy. Let's say, for example, you think next week, because of the election, maybe the Nasdaq is going to go up a lot, or the Russell's going to go, whatever it might be. You might just simply put a trade on to have that exposure and make money if the index goes in the right direction, lose money if it goes in the wrong direction. Quite simply, the advantage of these is that this is a very low-cost, liquid way of getting quick exposure to any of these major indices. You can also, though, think of this as a long-term instrument. So let's say, for example, you have a futures account, but you don't have an easy place to buy stocks directly, or you're worried about taxes. Well, you can actually have a world-class stock portfolio simply by buying and rolling long positions in these stock indices. You can, for example, buy S&P futures, and every 3 months you roll them. You will get long-term compounding exposure to the index in a way that is tax efficient from a cross-border perspective. Of course, the thing to keep in mind here, you don't want to do this in a place that has capital gains taxes. You'd probably want to do this in a place if you're not paying capital gains taxes. Finally, I've mentioned a lot the relative value trade. Let's say, for example, if I think that small caps are going to outperform the Magnificent Seven over the next 1 month, I might buy Russell futures and I might sell Nasdaq 100 futures. So that would be another way that I could put that position on. So always you want to look at position sizing, relative exposure, and so on. But these are all things you can really do with just a few clicks in your account. As mentioned, I would love to do a whole other presentation on futures options and index options, but we'll leave that to next time. And now I want to go ahead and open the floor to questions. I'll just briefly leave this slide up here for any of you who would like to look me up. As mentioned, my name is Tariq Dennison. You can Google my name. As far as I know, I'm the only Tariq Dennison in the world. You can find me on Seeking Alpha, where I publish a regular newsletter called the Expat Portfolio. I also do put updates both on X and on YouTube, and you've got my email address and company website. So with that, I'm going to go ahead and hand the floor back to Nick. Nick, did we get any questions about something other than the election?
Well, first of all, I'm going to start with a mini bit of advertising from the CME, because yesterday they announced a new micro on the Nikkei, denominated both dollar and yen. So I thought, as we're talking about indexes, I know we'll be talking about the US particularly today, but there is a micro Nikkei index being launched by the CME. Once again, check their website out for that. I want to throw in a question, and it will be election specific, but rather than just saying what do you think is going to happen, hypothetically, what do you think would happen to these different indexes if Trump wins compared to what happened when Trump won in 2016? Do you think it's going to be a very different reading of the markets if Trump gets a second term compared to when he got the first term?
Well, I think there's a few things we have to weigh there. First of all, when Trump won in 2016, he won what is called a sweep. So not only did he win the presidency, but his party also won the House and the Senate, solid and clear majorities. And one of the big impacts you saw there was the Tax Cuts and Jobs Act, which was a huge tailwind for American business, especially any American business that pays high corporate taxes. For example, the one example I saw a lot of was Pepsi. Pepsi had a huge release of tax reserves on the back of the Tax Cuts and Jobs Act. And you can probably go through all the S&P 500 components and see that. So factor one is not just who wins the presidency, but also what the House and Senate makeup are like. The current odds-on favorites are that the Republicans are likely to take the Senate and the Democrats are likely to take the House. So keep that in mind in terms of even if Trump wins, if he does not have a majority in both houses, he's likely to get a lot of pushback to similar sorts of measures. The other big difference to keep in mind is our starting point. So remember in 2016, we started with the US had the highest corporate income tax rate in the world, had lots of things from the Obama era which kept American business relatively uncompetitive, and the Magnificent Seven had not risen to the level that they have in the 8 years since. So you have to put all of those factors into consideration to consider what sort of impact could a second Trump term have. You're probably not going to get the same sort of boost from a tax cut because that's already happened. You're probably not going to get the same rise in US indices because, again, that's already happened. I also don't think going outside of US indices, I also don't think you're going to get the same clobbering of Chinese indices because that's already happened. So the bigger factor, I think, to watch is really what his policies do to small caps. So the number of all these four indices, the one that I think could have the biggest impact from a Trump win would be the Russell 2000. And there we need to roll up our sleeves and do a little bit more work to say what specific plan would he have in mind that could get through both houses of Congress as they are, and how would that actually benefit those Russell 2000 companies, which in my view really have been left behind over the past 8 years.
Okay, and I know we've been talking specifically about indexes, but just because we have the election next week, just for the group here that have joined us today, we were talking earlier. We actually think the bigger impact may be interest rate based rather than stock based.
Yep, that's my view.
Just let us know your thoughts on that, Tariq, because I don't think people are really looking at that. I think people just look at the the S&P and the Nasdaq and. That's kind of the showstopper, but really, I think the impact down the line on interest rates actually could be far more interesting and far more compelling story out of the back of this election.
Oh, indeed. And this is why I was surprised when I was doing this webinar series. I started with soybean oil and crude oil, and then we talked about Bitcoin, and then we talked about equities. And I said, Antoine, please, 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 can I also do one on interest rates or bond futures? And this is where I want to say we really should do one on bond futures, because by far my best attended webinar in January of this year was basically on how to buy bonds. I mean, bonds came back and they still are back to the extent that you can really earn yield on bonds. And I think when I talked about the impact of the election, over the past 1 month, we've seen yields on longer term US bonds rise about 40 basis points, 0.4 percentage points, despite the fact that the Fed cut rates. Now, why is that? Well, when the Fed cuts rates, they're not fighting inflation quite as aggressively. But on the other hand, neither of the two candidates and neither House of Congress really seems to care about balancing the budget. The last time we heard about balancing the budget, maybe 2012, 2016, but no candidate is talking about it this time. So what that means is deficits as far as the eye can see. And unlike the Kamala Harris campaign, Trump really isn't looking at raising taxes on anyone, which so far the estimates are that deficits would be higher under a Trump presidency than under a Kamala presidency. And we're likely to see showdowns. Now, what do deficits mean? Deficits mean that there are more and more bonds getting issued. The supply of bonds is higher. The demand would presumably be the same. The price would be down. Interest rates would be lower. If you're holding bonds and if you want to protect against that, what is the simplest way to bet on rising interest rates or falling bond prices? Well, it's to sell CME bond futures. And full disclosure, I have those positions on. I've made money in this recent rise because I was short CME Treasury note futures. And my estimate, and it's a kind of a rough, wet finger estimate, is that under a Trump presidency, we're likely to see long-term yields about 0.5 percentage point higher than we would under a Kamala presidency. And that's quite simply due to higher spending, which I also see as being more stimulative. I also see that the US growth rate would likely be stronger because I do believe he's more aggressively pro-business. And especially if we see that fielded down to the Russell 2000, that would matter. Now, that does make things a little bit tricky because the Russell 2000 is more interest rate sensitive than the Nasdaq 100 is. If you look at the components of the Nasdaq 100, you'll notice they don't care whether interest rates are 6% or 1%. And we've really seen that with when interest rates rose, they didn't really get hit at all. Whereas a lot of the components of the Russell 2000, I've heard a saying there among some of their CFOs, is called survive until 25. So basically what they're doing is they're really trying to just keep their cash flow long enough to pay down their higher interest in 2024. And once interest rates start coming down in 2025, they'll have a little bit more breathing room. So this is where on the equity side, the two really are related. You do have to look at which companies are borrowing on floating rate loans, because they're the ones that are getting squeezed the most by high interest rates.
Okay, I do have a few questions that have come in, so we'll try and get through these as quickly as possible because I know time is here. First one is, how is investor sentiment adjusting to potential disruptions or supply chain issues, particularly in sectors heavily influenced by global trade?
Oh my! You said we didn't have that much time. That's like a multi-year theme here. I mean, the supply chain disruptions, of course, was a very big theme during COVID and the year after, so 2020 and 2021. And I think the good news there was that shock has made a lot of supply chains much more robust this year than they were then. I think we can all say in 2020, the global supply chains were not ready for that shock. If anything, right now, I think you're seeing an overcapacity in some areas because some supply chains were nearshored. They had some steps that were cut out. Extra capacity was added, and whenever that happens, it suddenly means, well, we've got more capacity than we need. You're going to see shipping containers that are going across not even 100% full anymore. I think the bigger question, of course, is not so much this might be where the question is not so much an actual shipping and logistics question, but more where the supply chains are. For example, how much more are companies going to be diversifying away from China? If you look at the Magnificent Seven, one of my biggest picks there is they have a lot more China exposure than people are willing to admit. And many of those companies have really found it hard to quit China or to diversify away from China. I think that's actually a good thing because I think that keeps China in the loop, and it means that we're far less likely to go to war or to have another unpleasant escalation. But it does make things tricky for anyone who wants more geographic diversification. That's again a much longer story there, but.
Well, maybe this one would be a shorter answer for you, but it's quite a nice little question. It's how does interest rates affect the S&P and Nasdaq?
Okay. So in two ways. One, interest rates in theory represent the discount rate on future profits that these companies are making. So let's say, for example, NVIDIA and Apple and so on, these are growth companies which you expect to make huge profits in the future. If interest rates are higher, profits 10 years from now aren't worth as much as they are when interest rates are lower. So in theory, higher interest rates should make growth companies less valuable relative to value companies. We saw that happen in 2022 when interest rates went up and all these companies came down in value. But since then, they've all recovered quite a bit. That's because of that second factor. The second factor is that generally Nasdaq 100 companies, because they are non-financials and relatively tech heavy, have very, very little interest rate sensitivity. They tend to have very, very little debt. Those that do have debt have very long-term low interest rate debt. So if you look at Google, for example, they issued 40-year bonds at 2% interest back when interest rates were that low. And that, in hindsight, looked like a brilliant move. If you've got that amount of money locked in for 40 years at 2%, no wonder you're going to have an advantage. They could probably start a bank and and outcompete several banks that way. The S&P 500 does have more banks in it. It does have more real estate companies. So it has more interest rate exposure. But of the indices, the Russell 2000 has a lot more interest rate exposure than the S&P or the Nasdaq.
Okay. We've actually got a lot of questions today.
Oh, great.
A lot of them aren't election based, but I'll try and get through these if we have time. So how do geopolitical tensions impact US indices, and what role does international trade relations play in their performance?
Well, another very general question. So I would say the impact on US indices in the short term really is only about sentiment, and even then it's very, very noisy. I think, as we saw, the whole indication of who's going to win the election has been seen a lot more in interest rates than it has in the movement of the S&P or the Nasdaq. That said, when you talk about globalization, the election that really decided that was the 1992 election. So I often say, go back and look at Ross Perot's infomercials from 1992. That was the time when Americans decided they were going to go the route of NAFTA and eventually the route which let China into the WTO. That was a very, very different route of globalization and what US companies would look like. That was decided in 1992. And I would argue that Trump only came to power in 2016 because of that decision made in 1992. Now, the election of Trump in 2016 did put the US on a somewhat different trajectory again. I do not think we would be talking about decoupling from China or China plus one or anything if Trump did not win in 2016. I do not think that is an issue in this election quite so much, because if you look at the issues that are being debated, between Harris and Trump, global supply chains really aren't one of them. They both mostly agree on being tough on China, although Trump is a little bit more aggressive on tariffs there. He's a little bit more aggressive on bringing certain industries away, especially in terms of semiconductors. And those, of course, are going to have some impact on supply chains. But, I don't think we're going to really see the impact of it in the short term. So if you're looking for factors to drive your futures trading strategy, I will have to say I don't think the election would be that on US indices.
Brilliant. Look, I think we're just about at the end of time, so I don't think we're going to get the other questions in. I do think that we're going to have to invite you back for our next series, because we do need to cover the bond market 100%.
Wonderful.
Wonderful. I know you're very interested in it. Obviously, you won't be here with us. Obviously, we have an in-person seminar in 2 weeks' time. Obviously, Tariq won't be joining us, so we are welcoming you back with a.
Do you want me to check my calendar?
Well, you can come along and attend if you like, but we already have the legend that is Bill Papura, who's coming back to basically pick up where he left off, talking to us about gold and the gold markets. Bill has been a member of COMEX for over 40 years. Obviously, COMEX being part of the CME group now. And this will be on the 12th of November in the Boddington Hotel in Jumeirah Lake Towers. Please reach out to us if anyone needs information on it. We're happy to provide it, and registration is open already. Tariq, we thank you so much again. We thank the CME Group for sponsoring and being co-sponsors of this. We look forward to welcoming you back. And obviously, we're going to kick off, aren't we? The decision's already made. We're going to talk about the bond market.
Awesome. I'm looking forward to it.
Okay, so let's all sit back now and enjoy the election and see what happens, and probably be more fun for me than watching the UK budget.
I'm sure.
All right, guys. Thank you. Thank you very much, everybody's attended. Take care. Enjoy the rest of your afternoon, morning, evening, wherever you are in the world. And we'll see you next time. Well, hopefully in person on the 12th in Dubai.
Thanks, Nick. Thanks
all.
everyone.
Bye.